Now, we all know that climate change is one of the most pressing issues facing investors today. To share some insights on this topic, we now have a panel on the Inevitable Policy Response Project, looking at how governments will be forced to respond to our rapidly changing climate. To introduce the session, here's the PRI's Director of Climate Change, Sagarika Chatterjee.
Thank you, Susanna. Welcome to this session on the inevitable policy response. We'll be exploring transition risk and the prospect of a delayed forceful policy response. My guests today are Thomas Kansy, Executive Director of Vivid Economics, commissioned by PRI for our work on the inevitable policy response. Welcome, Thomas.
Hi, Sagarika. Glad to be here.
And also with me is Jessica Malmfors, who's CEO of Nordea Investment Management. Welcome, Jessica.
Thank you, Sagarika.
And Michèle Lacroix, Head of Group Investment Risks and Sustainability at SCOR. Welcome, Michèle. So why are we having this session? Well, you heard at the PRI Signatory General Meeting about initiatives on Paris alignment, including the Net Zero Asset Owner Alliance. Later, we've got more sessions on Paris alignment, including on the EU platform on sustainable finance and taxonomy. How does it all fit together? Well, we see two themes for investors. One is climate risk assessment, and one is Paris alignment. Climate risk assessment is important to informing Paris alignment actions taken, as you need to understand the nature of the risk, time horizons, and how transition could happen. The inevitable policy response is therefore a step towards understanding and acting on net zero. And with that, I'm going to turn to Thomas. Thomas, tell us about the inevitable policy response.
Thank you, Sagarika, and welcome all. Hi, everyone. So I'm Thomas Kansy, I'm a director at Vivid Economics, and I'll tell you all the things about the inevitable policy response, the reason why we're doing this work in the first place, then going into more detail on why we think there is an inevitable policy response in the first place, when this will happen, and then the three major parts of information: what it looks like, so all the policies that underlie this, what the economic impacts are on the real economy in the forecast policy scenario, and last but not least, the financial impacts that go much deeper into strategic asset allocation and the impacts across and within asset classes. All of this material is available online on the PRI's homepage. So if you Google Inevitable Policy Response PRI, you are directed to the landing page and you get the full information of what the inevitable policy response is, the full policy forecasts that we have prepared for this, the full forecast policy scenario, including all the spreadsheets underlying the results. So you get the breadth of and the width of the full scenario, as well as the financial impacts, including a portfolio tool where you can check how you are currently prepared for an inevitable policy response. So with this, of course, this is representing a consortium that has been carrying this out, but let me tell you a bit more about why we do this in the first place. So what we think is that, and investors agree as well, is that at the moment, a forceful policy response to climate change is not priced in fully. At the same time, we think it is inevitable that governments will be forced to act more decisively on climate change. And so this discrepancy exposes investors and investor portfolios to significant risk. And similarly, the longer any delay on this one is, the more disorderly and disruptive that policy response will be, and therefore the higher the impacts are. And so as such, we prepared the inevitable policy response, which is a high conviction policy-based forecast of what this policy response looks like, how it affects the real economy, and how it affects the financial markets. Now, on the next slide here, what we think is why we think it is inevitable. The cost of inaction is rising. We see extreme weather events. We see new climate research coming out telling us that this will only get worse. And regulators and insurers have already caught on to this, with regulators warning on stability and insurers warning of an uninsurable world. At the same time, the cost of action is decreasing. Clean energy, cleaner technologies coming down in price. So the discrepancy between the high cost of action, the lower cost of action is getting smaller, and the influence and civil society action is kicking this over the line, where shareholders are demanding actions and civil society here, personified by Greta, are pushing for more action. Similarly, this is also what investors actually expect, that there will be more action. So here you see polls conducted at the PRI meetings, annual meetings, and PRI signatories in a large majority think that there will be a disorderly policy response. Yet at the same time, as laid out in the BNY Mellon survey, this is not really priced in. And we think that one of the reasons for this is that although people know that there will be a response, it is very hard to price anything in and to understand its impacts if there's no guidance on what it could look like. And so this is what we are providing here. We're providing a high conviction policy-based scenario that is transparent, it's complete, so we cover it globally. We put all the results publicly available online. We have, as I said, there's hundreds of pages of detail behind it. And very crucially, we are complete in this as well. So we incorporate land use. And this is important as we need to understand how do we look like over the rest of the century, what are the implications for land use, and where do we end up on a total emissions basis, and also what other actions we need to take. And so for this, we also are releasing next week a new paper, which is called the Investor Guide to Negative Emission Technologies and Land Use, as we will need some negative emission technologies and we need to rely on some land use, and particularly ending deforestation today and re- and afforesting as soon as possible to be able to mitigate some of the long-term negative consequences of climate change. So with this, let me show you through the first part of the inevitable policy response, the policy forecasts. The policy forecasts cover, as I said, they're complete and transparent, and they cover all aspects of the economy. So we see some of the heavier forecasts coming in terms of coal phase-outs, with early coal phase-outs for first-mover countries by 2030, and then a steady retirement of coal-fired power generation after 2030 in lagging countries, in part driven by policy, including local air pollution concerns, but also driven by the changes in the cost of technology. Remember, as the cost of action gets lower. So this is where renewable energy, and renewable energy including storage, becomes cheaper and more economical than coal. And so similarly, we see then a significant ramp up of renewable energy globally. We also see some electrification in the economy, most notably in transport, with ICE, internal combustion engine sales bans, with first mover countries by 2035. And just to context on these forecasts and the results, we published this in September 2019. So this is predating COVID and actually predating some of the policy announcement that we have seen since. So we are very pleased to say that, for example, the UK, where I'm personally based, is already committing to internal combustion engine sales bans by 2035. So anticipating this forecast that we have. Then we have other economy-wide policies on energy efficiency and, of course, in industry decarbonization. We provided with a realistic outview, so not necessarily a significant ramp-up of carbon capture and storage and other technologies that are not fully at the deployment stage. We have realistic views on what we think is carbon pricing and how it can be accelerated with carbon border adjustments. And last but not least, we provide policies that cover land use and agriculture. And similarly, these, in our view, are realistic forecasts that underlie also a just transition theory that ensures social and political feasibility. So all of these forecasts are based on current momentum, as we can see, and are not necessarily stretching beliefs in terms of, is it feasible, does it ensure a just transition, and therefore can it be implemented. When we do the modeling, and as I said, so all of these policy forecasts are available online, 150 pages plus details that you can look at. When we model these ones, we get the forecast policy scenario. And the biggest part of the forecast policy scenario is, of course, the emissions curve. So on this one, we can see, and also, in my view, the realism of our scenario. So here you can see in the orange dotted line, the baseline scenario, of the IEA steps scenario with a continued rise in emissions. And remember, this is the before the COVID slight dip that we currently have. But this is a business, sort of a baseline business as usual scenario where we end up at around about 3 degrees. At the same time, if you look at some of the other scenarios, for example, the IEA Sustainable Development Scenario, or from the IPCC, a 1.5 degree pathway, these ones have coordinated orderly action from today that significantly reduce emissions right away and continue to reduce them significantly over time. This is also what we think is not necessarily happening, and it is not happening, and therefore it's hard to price this in. What you then see in the thick blue line is the forecast policy scenario. You can see that there is some further action out to 2025, and then only after 2025 we really see a significant drop in emissions, but at the same time not a significant drop, not significant enough to get us directly on a 1.5 degree pathway, as we think that in the beginning it's impossible to do and put in these policies that quickly. So what we do as well is we lay out a pathway to 1.5 degrees, which becomes important for alignment of portfolios and other pieces. Now, let me tell you a bit then on what is happening in the real economy that we see. So we see a deep and rapid change in the energy system, with oil demand peaking rather rapidly, and it might peak now even earlier when we do the update of the policy, of the inevitable policy response. So we have new policy forecasts coming out in the first quarter of 2021, incorporating the US election, the recent Chinese and Japanese net zero announcements, the new nationally determined contributions, and of course an update when it comes to the changes in the economy due to COVID-19 and changes in technology costs. But we do expect that some of these will definitely still hold true in terms of a deep and rapid change in the energy system. Thermal coal virtually non-existent by 2040. Renewables generating approximately half of all electricity in 2030. Transport, we continue to see electrified with ICE sales bans, similarly supported by the falling cost of electric vehicles and really the switch that we can see already from car manufacturers to this. So we think that over 2/3 of passenger vehicles will be electrified or zero carbon vehicles by 2040, with a bit of a lag for heavy emissions vehicles. And we see major changes in land use, with deforestation virtually eliminated by 2030 due to internal domestic carbon pricing as well as international carbon pricing and nature-based solutions for carbon offsets. But also we see increased pressure on supply chains due to this. Now, I won't bother you with all of the details that you can see, just to show you on the next 3 slides some of the details of the forecast policy scenario. So you do get data tables that are akin to any of the major energy system scenarios that you see out there. So you get the electricity generation mix, fuel demand, what is happening to transport sector and so forth, both in slides, so you get the story, and in spreadsheets, so you can evaluate it for yourself. Last but not least, what we add in the forecast policy scenario in comparison to many of the other scenarios is a full view on land use. So this is looking into bioenergy, it's looking into forest land and afforestation and the value that is created there. And as I said before, we're releasing an investor guide to unlocking some of that value. So the investor guide to negative emission technologies and forest, and that will be released next week. Now, the third and last piece, of, so just very quickly, the third and last piece of information that we pulled out is the financial impacts, where you can see the key equity market findings online, and you can see that we think that 3.1% or 1.6 trillion are at risk on equity markets, with a significant variation across and within sectors. We provide this further breakdown into subsectors, of course, as well, and we provide it as well for across asset classes, so to be applicable for strategic asset allocation. So sovereign debt, corporate bonds, private equity, real estate, equities themselves, as I just laid out, and infrastructure. And so within this, there is a lot more detail available on what some of the high and low carbon opportunities are within this, what the spread of impacts are, and how this affects the various asset classes. So including, as you can see on this slide, the spread of impacts on on corporate bonds. Last but not least, we lay out together with PRI actions for investors. In this one, it is really all about drawing on the inevitable policy response when it comes to forward-looking analysis, such as under the TCFD, for transition risk analysis, and looking at the 1.5 degree as well on future alignment. So with this, Sagarika, thank you very much for your time. I hope this is a brief overview of the inevitable policy response, and all of these results are available online, of course.
Thank you very much, Thomas. And I also just wanted to clarify from the PRI side that the inevitable policy response is not saying you don't have to do anything, just wait until 2025. In fact, we're saying the opposite. We're saying take this forecast policy scenario very seriously, think about it, and then you need to act now. And we absolutely need investors undertaking policy advocacy. And partly for this reason, PRI's in addition published some country policy briefings drawing on this vivid analysis, and you will find that available on the PRI website, including policy recommendations that we'll be engaging on. So I'm going to turn now to our investors and take a step back, and I'm going to ask you first to tell us a bit about your overall approach towards climate change before we go a bit deeper into how you look specifically at climate risk. So Jessica, if I could turn to you first, tell us about your overall approach.
Thank you, Sagarika. Nordea Asset Management manages around 223 billion euros in assets. And we have a broad mix of asset classes, mainly within multi-assets, equities, and fixed income. We service around 800 distributors and institutional clients across the globe, and we have a very high focus on ESG. I would even say that it is the top priority on our strategic agenda. We have recently adopted a new climate strategy, and that is built on 5 pillars. The first one being integration. And it has been key for us to integrate climate risk into the investment process. And one way to achieve that was that we decided to place the responsible investment team consisting of around 20 FTEs in the investment organization. Another thing, or the next pillar would be engagement. And we are based in the Nordics, and we have a long tradition of active ownership. And now we use that tradition to achieve climate resilience. We are part of the IIGC and the Climate Action 100+ initiative. And last year, we led the engagement with the Brazilian petroleum company Petrobras, and we also supported the engagement with Excel Energy. And in addition to that, we work with around 30 companies independently to enhance their work on climate strategy, reporting, and climate risk. The third pillar is divestment. And as much as we believe in engagement and dialogue, we also sometimes come to a conclusion that we need to divest. And that might be because we don't see that the company take enough action to do the transition, or simply because we no longer believe in the business model. The fourth pillar is product development, and around 30% of our assets under management are placed in our ESG products. And then that means that they all have a fossil fuel transition filter. And we continuously explore new products that support the transition to the low carbon economy. And we are very proud of one of our funds, the Climate Fund, which has become a blockbuster fund, which we started already in 2008. The fifth and last pillar will be the policy support, and we support the TCFD recommendation, and our ambition is to align all portfolios with the Paris Agreement over time.
Jessica, thank you. That's really helpful context. Michèle, likewise, could you tell us a bit about your overall approach towards climate change?
Sure. Thank you, Sagarika. SCOR is a tier one reinsurance company, and we operate both in property and casualty and live biometric risks. Basically, we own 20 billion of assets spread out across 70 different legal entities in various countries. We've always been concerned by climate risk. When you underwrite property and casualty business, insuring against natural catastrophes is part of your job. So it's kind of a raw material and part of our business. When we talk about climate risk, what is really new is climate change, and we make a big difference between both. Climate risk and climate change has been discussed at the highest level of the company for years, and we've not been waiting until it has become mainstream in the economy to take care about it. On our investment, we believe that taking action serves both strengthening the resilience of the portfolio and mitigating adverse impacts of our investment decision. So we've also built our approach around 5 pillars, or upon 5 pillars. One is risk management, and it's part of our DNA. Honestly, we are the art and science of risk. So integrating risks in our investment decision is really the core of our business. So we have been keen to build a more resilient portfolio against climate risk. We are also screening to enhance investment decisions. It can be positive or negative screening, exclusion, but also selecting best in class. We try to engage as much as possible to foster more sustainable behavior from companies. We have built a strong thematic investment bucket made of green investment, 1.3 billion, which is more or less 7% of our investment portfolio. This aims at financing a more sustainable world. And finally, we try to join initiatives such as the Net Zero Asset Owner Alliance and public debate. We have been member of the TEG at the EFRAG. We are also member of the Climate and Sustainable Finance Commission at the AMF. We do believe that we have knowledge on climate, and we want to bring climate awareness and to help the others to better understand it.
Michèle, thank you. So we're going to go a bit deeper now into climate risk management and scenarios. So Jessica, tell me a bit about how you look at climate risk management.
Let me just start by saying that we are now evidencing something that we have not seen before, and there is a huge transition in the mindset of clients, politicians, financial institutions to move assets into sustainable investments. And we as an industry need to do something good with this. But the challenge at the same time is really for both financial institutions, but for issuers to navigate among all different policies, initiative, regulations. And I mean, the alignment here is so important if we are going to reach a green economy in an efficient way. Nordea's mission is to deliver returns with responsibility, and integrating climate risk as well as other sustainability risks is really, really important for us. And you can have two different focuses on the Paris Agreement. You can either reallocate or you can do real transition. And we focus on real transition mainly. And that means that we work a lot with scenario thinking, both in relation to the physical risk, but also in relation to the transition risk. And we have divided the climate-related scenarios into 3 different use cases. The first one is the alignment analysis, and that is simply an analysis of whether a company is aligned with a scenario in which the goals will meet the Paris Agreement. And to do the alignment analysis, we use the Transition Pathway Initiative, the TPI, and we are also considering to use the CDP VVF offering since it offers a broader scope. The second use case is the stress testing. And there we look at different scenarios which are viewed as possible outcomes, but it does not cover or assign the probability of such an outcome. And we do stress testing to measure and manage both climate risks and opportunities, and this is also included in our risk reporting. But we have not yet come that far when it comes to the third use case, and that is the forecasting, which is relevant here. And that is similar as the stress testing, but then you also add an element of the probability to that outcome to actually take place. And in order to complement the more open-ended stress testing that we are doing with a better understanding of the actual probability of that transition to take place, we need initiatives such as the IPR. And we think it would be very helpful if the IPR could get a high recognition, a high status, possibly by becoming the benchmark included in the carbon delta model or similar. We work actively with selecting our scenarios, and we have highly skilled people in our responsible investment team who constantly evaluate the developments to ensure that we have the scenarios that are most suitable. We also think that it's important to be part of this development, and we joined the United Nations Environment Programme Finance Initiative in 2018, the pilot group, to address the need for analytical tools and indicators to report on matters related to climate risk. And the main outcome of that work was the climate value at risk model, which considers the impact on the total portfolio if climate risks were to be priced by the market today. And scenario analysis is not the same thing as a crystal ball, but it does reduce the uncertainty when taking the investment decisions. And in order to make the scenario analysis as reliable as possible, we think it is important to use several scenarios. So, for example, when it comes to the carbon delta model, we currently use 8 different 2 degrees scenarios. We also assess the results. We discuss the results with the portfolio managers, and we try to understand the drivers of the specific company or sector. And we have learned that the carbon delta model is more reliable for certain sectors and countries than others. The weakness with the climate value at risk model is that it does not take into account the efforts that a company is spending on climate transition and climate risk. And since we are an active asset manager, we will always complement the scenario analysis with active engagement. And we will do an assessment of the issuer's engagement to reduce carbon emissions or diversifying away from fossil fuel dependency. But it is clear that the scenarios, the climate value at risk analysis does help the portfolio managers to understand the risk exposure and also to take the investment decisions. And we do expect that the climate risk assessment will be more sophisticated as data tools develop. And again, it is really important that there is an alignment, the frameworks, the standardizations that are now exploding in this area. But we look forward to this. Thank you.
Jessica, thank you. That was incredibly insightful, taking us inside your business and how you're looking at this. Michèle, I'm going to turn to you now. Can you tell us a bit about how you're looking at climate risk management?
Yes, sure. First of all, again, as it's been a long time that we are dealing with this topic of climate change and climate risk, It deserves a lot of humility and pragmatism if we want to make it real in our portfolio. So we started on our side with physical risk because it was so easy to leverage our P&C colleagues' capabilities in modeling natural catastrophes. And we started to better understand what climate change means when it comes to increased physical risk, acute or chronic, and we used their tools to assess the risk in our physical assets. Then we slightly moved to transition because it became obvious that this should be the most impactful risk in our portfolio. And we started as early as 2018 with a heat map provided by Moody's in their analysis, analyzing 11 different sectors and assessing whether the risk was high or medium or low, immediate or emerging. It was already one step in trying to analyze this transition risk, but not enough because it was really kind of a top-down assessment with very few indication of potential quantification or order of magnitude. One point I would like to raise is basically when having done these two analyses, it became also obvious that physical risk goes in one direction. The more, the earliest and the strongest the transition, the more we will be able to control global warming. And on the other hand, if we are late in our transition, then physical risk should become the most important risk of our portfolio. This works as long as policymakers take actions early enough. Otherwise, we would be in the worst case scenario where transition will be strongly harmful and will not be enough to contain global warming. So we may be hit by both physical and transition risk. Then we move to a kind of a what-if scenario, thanks to the Green Investing Initiative and their study Too Late Too Sudden or Storm Ahead, in which we found this too late too sudden scenario, which is very close to what the PRI have done with the inevitable policy response. It was more or less the same type of Moody's analysis, that is to say, sectors or the investment universe was broken down by sectors and focus was done on most exposed sectors, but with a much more in-depth analysis, enabling us to map each and any ISIN code of our corporate bonds and equity bucket to better understand how much we may lose if those scenarios were to materialize. So basically, the benefits that we have taken is really a better understanding and a much greater awareness. When you come to top management with figures, even if you say that there is, we don't know the probability of these figures arising, it's only a what-if scenario, but you come with more than, come on, guys, there is a risk. You're able to try and let them understand that in terms of resilience, we can no longer be silent on this type of risk on our portfolio, and we really need to focus on it. So it makes transition real when you talk to top management, and this is for me the best benefit that we found in this analysis. Then data manipulation was also very interesting because it opens your mind to what is missing. How do we make the difference between best in class and laggards? How are we able to potentially protect our portfolio when selecting best in class in each and any sectors that may be impacted by climate change? But that's where you find the limitation of those analyses, because as of today, a sector is treated as one sector with no difference between, let's say, Total and Chevron, and we know that one is more engaged in its transition than the other. It also raises the question, several answers to the question how to implement a sector-neutral resilient portfolio that is aligned with the Paris Agreement, which may be quite tough. And more or less, it goes beyond only stress testing or what is scenario. It opens your mind to another way of defining your strategy, putting more emphasis on this best-in-class type of investment decision. And we have welcomed the exercise at both operational and top management levels. So it was really a big enhancement in the way we figure out this transition risk. But there are some limitations. First of all, I want to highlight the fact that it's a what-if scenario. All of those are what-if scenario, and nobody is able to know exactly what's going to happen. So it's more assumptions on assumptions. You have an assumption on climate scenario on which you build assumption on potential economic developments linked to this, and assumptions on political responses. So there are a lot of question marks still at stake. Anyway, it's at the very end, it's still a credit analysis in which you have to put this transition risk in each and any individual assessment that you make on the company you hold in the portfolio. So this is basically all what we have taken.
Michèle, thanks so much. Likewise for sharing, how inside the fund you're really trying to look at this and make sense of this. And some of the points you made were just so salient. So we've got some audience questions coming through. The first one is actually very easy. It's, will the presentation pack be available afterwards? Yes, it definitely will. And you can also find all these resources on the inevitable policy response on the PRI website. And normally this webinar recording will also be available. So the question I've got coming through that I'm going to direct to Thomas is, how does the pandemic affect scenarios? And I'm going to tweak that question a little bit to ask, how are you thinking about the pandemic in terms of the inevitable policy response? Does it change your perspective at all?
Thanks, Sagarika. And yes, that is the big question. We see big changes in the economy due to this, not only some of the short-term impacts on employment and economic structure, but we see some long-term shifts. You will have seen the revised energy forecast with different peak date of emissions, with different oil and gas demands corresponding to that, and the change in behavior. At the moment, this is all still playing out. So everyone is trying to do their best on the information that is currently available. So are we. We are updating the policy forecasts, and we are updating the technology assumptions in it. And similarly, we are updating when it comes to the economic structure of countries. I think this will still play out over 2021. And you will see that many of the previous forecasts just have to accommodate this. We put it out in 2019 before we saw the dip in COVID. And of course, now it's a different economic structure that we need to account for. So we're updating this over the next several months.
Great. And also updating for the China and Japan carbon neutrality announcements as well?
Yes, absolutely. So we see the carbon, the cycle of the nationally determined contributions and new climate targets that need to be incorporated in this. Of course, similarly, when the next 5-year plan is announced and the investment policies come in. So yeah, that all of these things will change how the forecast looks like.
Can I just add one thing in relation to the COVID-19? And I just wanted to add that, I mean, we can really see that has an effect on our client and how that actually bolsters the demand for ESG ESG products as such, and specifically climate products as well.
That's really interesting. So what you're saying, Jessica, is you've seen renewed interest and rationale for this whole area of ESG and climate risk management. Interesting. Michèle, maybe if I could turn to you, as you also so deep in terms of thinking about risk management. Has the pandemic taught you anything about risk management? Has it made you think differently at all about risk management?
Yes and no. I mean, again, as we are also a biometric life reinsurer, pandemic was already within our radar screen, not on the asset side, but already on the life risk management side. So it came as a surprise because all of a sudden a risk that you have been tracking over the years materializes. I think it has brought kind of a more holistic view across the company that climate risk, because the pandemic comes from climate change as well. It's linked to deforestation. It's linked to moving animals from their natural habitat to somewhere else. So it has proven how everything is intricated, and we need to think globally. And it has provided to us something that enables us to go beyond climate change and include biodiversity. So on the asset side, I really welcome, unfortunately, this pandemic, because it has given us the opportunity of demonstrating how we need to think once again out of the box and include much more than only climate change.
Thank you, Michèle. Well, I've got a bunch more questions that have come in through the chat. I just wish we had a little bit longer to answer them. Just to give you a flavour of the kind of things that you, the audience, are thinking about. We've got questions coming through about biodiversity, what tools are there? We've got questions coming through about why is it all about coal? Why aren't we talking about other topics like tobacco? We've got questions around how you're using CAT models and what's the public policy agenda around net zero. So I hope in time we can all try to work out the answers to these very important questions. We've come to the end of our session, so I'd like to very much thank our speakers. Thomas, Jessica, Michèle, you've shared with us how you're looking at this. You've taken us under the bonnet of your car, of the way you're looking at investments, and it's been very, very helpful. I'd also like to just highlight that you will soon find a new paper on the inevitable policy response on the PRI website next week. Thomas mentioned it. It's called The Investor Guide to Negative Emissions Technologies and Land Use. And if you're intrigued to hear what that is, we'll have much more coming out on that in due course. With that, thank you very much, all of you.
Thank you, Sagarika, and to all of the panelists for that really fascinating discussion. We'll be continuing in 15 minutes with a topic that is as crucial to social change as climate action is to environmental change, and that is human rights. See you soon.